Good morning, everyone. This is Charalambos Pissouros, Senior Analyst at IronFX Global, bringing you the morning comment for the 11th of March. ECB, no half measures this time. Yesterday, the European Central Bank delivered a surprisingly aggressive dose of monetary stimulus, announcing cuts in all three of its key interest rates and 20 billion per month increase in the size of its QE program and the launch of 4 targeted long-term refinancing operations. Perhaps even more importantly, the bank stated that its asset purchase program will now be expanded to include investment-grade corporate bonds from outside the financial sector and suggested that interest rates will remain low long after QE is over. All measures are intended to boost lending to businesses and disincentivize financial institutions from hoarding money. Following the disappointment in December, President Draghi and his colleagues moved in a manner intended to reassure markets that the ECB has neither diverged from its commitment nor is short of ammunition to boost inflation. The announcement of the measures caused the euro to plunge against its US counterpart and pushed European equities up on anticipation of cheaper capital. However, in the press conference following the decision, Draghi noted that officials do not anticipate to reduce interest rates further unless the facts change. This statement surprised the markets and reversed the sentiment on the common currency, as speculation that this was the bank's final easing package started building up. Euro-dollar skyrocketed from as low as 1.0820 to eventually reach a hard dollar at 1.1220. The stock market reversed the initial move as well. We believe that euro-dollar could correct lower, at least as we head into the FOMC policy meeting next week, given that the ECB exceeded market expectations and that monetary policy divergence between the Eurozone and the US is intensifying. Overnight, an article was published reporting that the People's Bank of China is preparing regulations that will allow lenders to exchange bad loans for ownership stakes in their companies. The move is intended to reduce banks' exposure to non-performing loans and to release capital that can be lent for other investments. This effort to revitalize growth by the Chinese regulations could revive global risk sentiment, and as a result, it is likely to support pro-risk currencies such as the Aussie and the New Zealand dollar, at least temporarily. At the same time, this could curb demand for safe haven assets such as the yen, the Swiss franc, and gold. As for the indicators today, Germany's final CPI for February confirmed its preliminary estimate and showed that inflation fell 0.2% year-over-year in Eurozone's largest economy. In the UK, the trade deficit for January is expected to have widened from the previous month. From Canada, we get the employment report for February. The unemployment rate is expected to have remained unchanged, while the net change in employment is expected to have turned positive. The forecast is supported by the stabilization of oil prices during the month and the statement of the latest Bank of Canada policy meeting, where officials noted that the employment has held up despite some job losses in the resources sector. Therefore, this could cause the loonie to extend its recent gains. On a longer-term perspective, given that the federal budget is due on the 22nd of March and is expected to include massive fiscal stimulus, we believe that employment could remain supported or even improve during the coming months. For more information, including technical analysis, please read the full comment on IronFX.com or download our app and get all the information you need to trade. Also, you can follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google Plus to get more trading ideas. This is Charalambos Pissouros, Senior Analyst at IronFX Global, wishing you solid trading.